What if your crypto didn't just sit there, but actively worked for you around the clock, powered by actual intelligence? What if the whole idea of passive yield from staking was already being replaced by something much, much smarter? There's a new category of what I call AI assets starting to emerge from the corners of the market where the smart money plays. And no, these aren't just tokens with AI slapped in the name for hype. They're autonomous systems designed from the ground up to actively trade, manage liquidity, and generate real yield. Think of them as software you can hire to put your capital to work while you sleep. This isn't some far-off futuristic trend. I believe we're seeing the quiet beginning of a massive capital rotation, moving from the DeFi of yesterday to the intelligent, autonomous finance of tomorrow. Remember, we are not financial advisors, and you should always do your own research before making any investment decision. And you can pause and read this disclaimer at your convenience. But let's be real. In a sea of overwhelming hype, with 1 million new projects launching every day, how do you spot the genuine game changers before the retail crowd piles in? Most investors will either be paralyzed by the complexity and miss out completely, or worse, they'll fall for a sophisticated-sounding scam wrapped in AI buzzwords. They'll be left holding the bags of 2024 tech in a 2026 market. And that's the real fear, isn't it? That you'll end up being the exit liquidity for the people who saw this shift coming months ago. So today, we're going to break it all down. I'll show you exactly what this emerging asset class looks like, why the old model of DeFi has some structural disadvantages, and I'll share the analytical framework I use to vet these new protocols. And yes, we'll get into the specific categories of DeFAI that forward-thinking investors are starting to explore right now. This is your playbook for getting ahead of the curve. To understand where the market is headed, you have to be brutally honest about where it's been. The old DeFi world, protocols like Aave, Compound, and Uniswap, was absolutely revolutionary. It proved we could build a financial system on-chain, no middlemen required. But its engine has a catch. It was largely built for cyclical, bubble-driven growth. Think about it. A lot of the yield in old DeFi came from inflationary token emissions. Protocols would print their own tokens to reward users, creating those insane, unsustainable APYs. Revenue was transactional. Fees from trading or lending that would boom in bull markets and then vanish in bear markets. The system scaled with the number of human users manually clicking buttons, bridging assets, and managing their own complex positions. That era isn't going to zero, but I believe it's becoming the boring, low-growth utility layer of the on-chain world. Now, enter DeFAI, Decentralized Finance supercharged with AI agents. This isn't just another niche. It's a potential horizontal layer for the entire AI economy. Instead of forcing users to navigate the insane complexity of crypto, DeFAI aims to use AI agents to adapt crypto to the user. The difference in the economic model is everything. Old DeFi's revenue is often transactional and cyclical. The goal for DeFAI's revenue, on the other hand, is to be recurring and operational, more like a software-as-a-service business. These AI agents aren't just simple bots. The vision is for them to be autonomous workers you can hire. They perform tasks, managing liquidity, executing complex trading strategies, optimizing yield across chains, and they earn fees for that work. This is the core of the Great Rotation thesis. Why hold a static governance token that just gives you the right to vote on a protocol that's becoming a basic utility, when you could own a stake in the AI workforce that's actively generating revenue on top of it? The thesis is that capital will flow from passive, governance-heavy assets to active, operational AI agents. So how do you audit your own portfolio for this shift? How do you separate the future-proof assets from the tokens that might just be dead weight? This isn't about panic selling everything. Core infrastructure will still be vital. This is about identifying tokens whose value is disconnected from real, sustainable revenue. I use a simple three-part test. Feel free to copy it. First, is there real, non-inflationary cash flow? I look for protocols that earn revenue from actual use, like trading fees, interest, or service fees, and share a piece of that with token holders. If a protocol's yield is mainly just at printing more of its own token, that's a huge red flag. That's not yield. It's just slowly diluting your own investment. Second, is there an AI or agent integration roadmap? The future of on-chain operations is automation and intelligence. My view is that protocols not actively building or integrating AI agents to manage tasks are at risk of being outmaneuvered. Their functions could simply be abstracted away by a smarter, more efficient AI layer. If the team isn't even talking about agent-based systems, you have to ask if they're building for the past. Third, is there clear demand beyond the crypto-native speculators? A project's long-term survival depends on attracting users from outside our little bubble. DeFAI is positioned to do this by hiding the complexity. You shouldn't need to know what a liquidity pool is to simply tell an AI agent, swap my ETH for USDC and find me the best safe yield. If a protocol's user base is just mercenary farmers chasing the next high APY trend, it has no real durable advantage. If a token in my portfolio fails these three tests, I consider it a prime candidate for rotation. It's not about feelings, it's about spotting a structural disadvantage. Analyzing these new protocols requires a completely different lens. To get these DeFAI breakdowns delivered straight to your feed, make sure you like this video and subscribe to BlockStarU. It really helps the channel grow. Now that you have the framework, let's look at the categories that investors are starting to rotate into. This isn't about shilling specific tokens, but about understanding the new building blocks of this autonomous economy. The first category is AI-managed liquidity and trading. In old DeFi, providing liquidity was a manual, high-risk game where you were constantly battling impermanent loss. New protocols are emerging that use AI agents to dynamically manage liquidity for you. The idea is for these agents to monitor market trends and volatility in real time, concentrating liquidity where it's most needed to maximize fees and minimize loss. For example, projects like Singularity DAO are building what they call dynasets, which are baskets of assets that they state are automatically managed by AI. Their ambition is to create the evolution of the index fund, not just a passive basket, but an actively managed portfolio run by an algorithm. The second category is the agent infrastructure layer. This is the picks and shovels play. Instead of betting on one AI application, you can invest in the framework that allows AI agents to operate on-chain in the first place. Projects like Fetch AI are working to create a decentralized network where autonomous agents can be built, deployed, and communicate to perform tasks. Think of it as a potential operating system for an AI-powered economy. While many use cases are still in early development, these agents could be used for everything from DeFi trading to optimizing supply chains. Investing here is a bet on the growth of the entire autonomous agent economy. The third, and maybe most critical category, is AI-powered security and monitoring. Let's face it, the biggest thing holding back DeFi adoption has always been risk. Exploits are everywhere. A new breed of security protocols is using AI to fight back. These systems are being designed to monitor on-chain transactions in real time to detect strange behavior, like the patterns that come before a rug pull or a flash loan exploit. For instance, protocols like Blockade are building security tools for the broader Web3 space, protecting wallets and dApps, which will be essential for allowing both human and AI agents to transact on-chain safely. As more value moves on-chain, owning the infrastructure that secures it could be an incredibly powerful position. These three categories, AI-managed assets, agent infrastructure, and AI security, are areas I believe will form the backbone of the DeFi revolution. They're where intelligent capital is positioning itself for the next decade. All right, time for a dose of reality. This is a high-risk, high-reward frontier. Anyone who tells you otherwise is selling you something. There are three major risks you absolutely have to understand. First is smart contract risk. This is true for all of DeFi. Code can have bugs, and those bugs can be exploited, which could lead to a total loss of your funds. Always look for protocols that have undergone multiple, reputable audits. Second is model risk, and this one's unique to DeFAI. What happens if the AI is wrong? An AI trading model that looks perfect in backtesting can still get wrecked by unforeseen market conditions. An AI is only as good as the data it's trained on. You are trusting an algorithm with your money, and no algorithm is perfect. Third is position sizing and portfolio management. Because this space is so new, you have to manage your risk. A simple way to think about it is in sleeves. You might have your core holdings like ETH. Then you have your emerging DeFAI sleeve, which should be a smaller, higher-risk portion of your portfolio. And maybe you have a conservative sleeve with stablecoins. Allocating a small, responsible percentage to this high-growth sector is how you get exposure without betting the farm. The next 2 years are going to define who wins and who gets left behind in this new DeFi frontier. The shifts happening now are faster and bigger than anything we've seen before. If you want real-time insights into emerging protocols, tokenomics breakdowns, and deep dives into the AI engines powering this revolution, you need to stay plugged in right here. So take a second right now, hit that like and subscribe button. Don't wait until this knowledge becomes mainstream. We're just getting started, and the next drops are going to change how you see DeFi forever. The shift we're witnessing is fundamental. My bet is that the future of on-chain yield is active, not passive. It's intelligent, not static. By understanding how to analyze these emerging AI-driven protocols, you can position yourself ahead of the retail wave and on the right side of this great capital rotation thesis. DeFi isn't dying, but the bags of passive, valueless governance tokens from the last cycle just might be. The choice for the next 2 years is simple. You can be the person whose wallet holds idle assets, just hoping for the next bull run to lift everything up. Or you can be the person whose capital is actively put to work, hiring an army of software employees that can earn for you, day and night. The autonomous economy is coming. The only question is what role you'll play in it. I want to know what you think. Which category of DeFi protocols are you most excited about? Let me know in the comments below. The crossover of AI and DeFi is just getting started, and we'll be covering it every step of the way. Subscribe so you don't miss what's coming. You've already done the hardest part by starting. Now keep your momentum going and tap the video on your screen so we can build the next level together.